Should I invest if I'm in debt? So the market has been going crazy over the last couple weeks, right? S&P 500 was going down and down and down. And everyone's saying this is a great time to get into the market. And it is. It's a great time to be investing. But should we be investing if we're in debt? And here's just my take on it, right? Because I'm not a financial advisor. I'm not some financial guru. I don't have some finance course to sell you, nothing like that. Just sharing my opinion and what I did. And I'd say that it depends on what kind of debt you're in. So for me personally, I had credit card debt and I didn't invest anything into the stock market when I had credit card debt. And here's why. The credit card debt that I had was at almost 30%. So this means that, I have $1,000 in credit card debt. I would be charged, if I just held that debt there over the year, I would be charged an extra $300 just because I owe them money. So I ended up paying $1,300 over the year. And so if you're investing in something like the stock market, anything that you're investing in, it would only make sense for me to make an investment when I have debt like that if I know that that investment would yield me more than 30% return on investment in a year. Like if I knew that I would get 50% return on investment, then yeah, I would make that investment and then I would just make the minimum payments on the debt because, I would end up being positive 20%. 50% minus 30 is 20. But here's the thing. You're not going to invest in anything in the stock market that's going to give you a return like that. So the best thing that you can do, in my opinion, and this is what I decided to do for myself, was pay off all the credit card debt. I took the money that I want to be investing in things and I just paid off the debt. I made way more than the minimum payment, just paycheck after paycheck, until the debt was wiped out. Same thing with your student loans. You have to really look at, okay, what's the interest that I'm paying on this? If the interest that you're paying is like 5% on student loans, then, the S&P 500 gets you like a 7% year over year return over 10 years. And that is adjusted for inflation. So you could make a positive argument that, hey, it makes sense. My student loan debt is 5% interest. I actually gain more than that. Just investing in a simple index fund like the S&P 500. So, hey, it makes sense to keep up with my student loan payments, pay that stuff off, but also to be putting money into the S&P 500 every paycheck as well. Because the interest that you make from the S&P 500 is higher than the interest that you're paying from the student loan. Do you see what I mean? And this is why I say it depends. It depends if you should invest when you have debt compared to if you don't. If you don't have debt, then definitely invest. So here's what I did. I took those payments and I paid off my credit cards. I still use my credit cards, by the way, but I pay them off every month. I have multiple cards, and one of them has just a $500 limit on it. Really easy. It makes it easy for me to budget everything that I'm spending my money on every month. I only use that card. I have other ones, of course, but I use that one for all of my purchases, going out, getting groceries, buying random things from the store, going out to dinner, things like that. And once it's maxed out, I'm like, all right, no more spending this month, even though I have money in my bank account and all that stuff. And then, at the beginning of the next month, I pay that card off in full. And that's just what I do to manage my personal spending. So I'm always spending less than what I make. But because I pay it off in full, I don't pay interest on that. You only get charged interest on your cards if you carry the balance. So I paid off in full, so I don't get charged interest. So then I take my cash, the cash that I was paying credit cards with, I was paying a large amount every month to pay these down. I take that same cash and then I put it in other investments. High yield savings account. Right now, I've actually been contributing less to my high yield savings account because the market is going down. The market is going down. That means that the normal stocks that I invest in long term are at a discount. So I'm putting more money into the discounted stock. Everybody always says, buy low, sell high. But it's funny. The stock market is like the one place where if you already have stocks and you see it get low, people get scared. And then they're like, oh, it's going down, it's going down, it's going down. I should sell so it stops going down. But as soon as you sell, you lock in those losses, right? So like the smart thing to do is you see that it's going down. You're like, okay. And this applies to an index fund, not individual companies, right? Because individual companies can go out of business, and then you actually did lose that money. Like if you had a lot of stock in Radio Shack, and you see the stock going down before they went out of business, well, shouldn't buy more of it, because they're gone now, and that money's lost, right? But if you have it in a fund, like an index fund that's distributed amongst a lot of different companies, well, you don't have to worry about that index fund going insolvent and you losing your money. So you just keep investing as it's going down and invest frugal amounts, but you will get more for every dollar that you invest because you're putting more money in when the price is lower. What most people do, and what I used to do, is I would see a stock going up, certain stocks for certain companies, I'd see them surging, and everyone's talking about them because everyone's excited because people who invested before are now making money because the stock is going up, right? And everyone's talking about it. It's on news, like Nvidia a couple years ago, right? It's like everyone's like, oh, Nvidia's going crazy, and I'm really proud of myself from when this was going on. I didn't go, let me go buy a bunch of Nvidia stock right now that it's like super expensive. I was like, nope, like you missed that one. It's okay. I did buy a little bit of them. I have some of them now because I saw the prices for everything's going down. So it's like, I'll buy some of this stuff. But what I put the majority in is S&P 500 because I know that for sure is going to bounce back up. Other companies can go insolvent, right? And you really have to do your research on companies. But we're getting into a whole different thing here. The thing is, if you are in debt, and this is personal debt, you want to look at the interest rate of your personal debt. And you want to compare it to the returns of said investment that you're making. If the returns of your investment are higher than the interest rate of your debt, then it makes sense to invest. If the interest rate of your debt is higher than the returns of the investment that you're looking to make, pay that debt off. Allocate all that cash to paying that off. You'll actually be paying less money in the long run. You're going to be free from that debt, and then you will have more capital to be able to allocate towards that investment that you want to make in the future. So yeah, the market has been, I wanted to make this because the market's been like going crazy right now because of all these tariffs and that, Trump is imposing. People are like, hey, are these tariffs actually going to go into effect tomorrow night, or are they not going to go into effect? What's going to happen? There's a lot of uncertainty in the market right now. And because of the uncertainty, the prices of everything is just going down. It's like a flash sale on all these stocks. And so because of that, people are saying you need to get into the market right now. And I wanted to make this video so that you know that if you have a bunch of debt, don't even worry about that. Pay that debt off. If you don't have a bunch of debt and you really do want to get into the market, I just made a video about exponential growth and about what Trump has been doing to the market to kind of help you be able to decide what maybe you should invest in. If you are ready to do that, you can check that out. It's somewhere up here on the screen. See you in the next one.